serves a nationwide network of financial professionals. Call 1-800-290-7226 or email thequest@brokersalliance.com. And remember, when you need financial guidance, call Brokers Alliance.
Well, welcome back to the Quest for Financial Freedom. I'm your host, Steve Saban, and of course with me today is Ken Davis from Bell & Associates, the Vice President of Advanced Markets, and we're talking all today about to Roth or not to Roth. That's the question. You can write me, thequest@brokersalliance.com, or call toll-free 1-800-290-7226. That's 1-800-290-7226. Well, Ken, in the last part, we just started getting into this whole thing about Roths and is it a good deal, is it a bad deal, and we talked a little about this early in the week. Talk a little bit more about it and kind of lay it out for everybody so we have a really good idea what we should at least think about or consider.
Okay, let's go back to basics real quickly. A traditional IRA is deductible up front, tax deferred in between. Remember, tax deferral is our friend, and then fully taxable at the end, and before 59.5, 10% penalty. Okay?
Oh, I hate that.
The Roths, on the other hand, just kind of switch that up. No deduction up front, tax deferred in between, and then it comes out tax-free if you're 59.5 or older and it's been in there at least 5 years or more. Now, where the Roth IRAs really start to sing is if you get to the point where you really don't need that money to live on. You're in retirement, you get the IRA sitting there, 70.5 hits. Traditional IRA, what happens?
You have to take minimum distributions.
You have required minimum distributions.
Required, yeah.
RMD, required minimum distribution, has to start coming out because the government wants their taxes now. They're forcing you to make that distribution, and you may not want to, and it may not be to your advantage, and it may trigger all these other taxes and things we talked about. A Roth, on the other hand, doesn't do that, and there is no forced distribution, and when the distributions come out, they're tax-free. And then you can do some cool things with next generation planning in terms of pushing these deferrals into the next generation for the children and possibly grandchildren situations.
If I really thought, but by the way though, if I have what I kind of like appealing about the Roth, especially if I'm in a lower tax bracket anyways, right?
Yeah.
I mean today, now not that we are, but let's just say we had people listening that said, hey, you know, I'm not in that big a bracket, and I don't know if it's going to really be that big later on. If I take my Roth IRA distributions out of that, does that affect my Social Security? Because, you know, we've been talking about that all week as well.
Well, if you convert a regular IRA to a Roth, you're going to create a large taxable event for 1 year that could impact the taxation of Social Security. But
if I take
once
Roth
you've made
now,
that conversion, or if you had the Roth in the first place, no, that doesn't impact the formula to determine whether or not Social Security is taxable.
But my traditional IRA, could that calculate?
Of course. Your traditional IRA flows into the front page of the return, flows down to adjusted gross income, and that, with some modifications, determines whether or not your Social Security income is taxable.
Well, let's just back up for a second then. Would it be worth people who are before 59.5? I'm just thinking, you know, or well, actually, anybody that's not taking any Roth, if they were going to make contributions going forward, they thought they're going to be in a kind of an average tax bracket, and they didn't want to have their Social Security tax. Now the Roth might have a little more power at the back end, right?
That's right. I mean, if you can get by and believe that, in fact, it will be tax-free on the tail end, and that the tax rates won't be through the roof, and we, you know, right now we think the tax rates are going to go up. Who knows? 10, 20 years from now, the whole financial situation could have turned. Maybe tax rates are now on the downturn. We just don't know what the future holds, so we're having to do some guessing. I think one of the major things is if you think tax rates are going to be a lot higher in the future, then maybe the Roth is a better way. If you have enough wealth that you want to leave it to the next generation, a Roth may be a good choice for you. There's no easy solution to that, answer that question. You really need to work with your advisor, CPA, tax accountant, or tax attorney to run numbers and see what you think.
In my thinking, though, I think even if I thought tax rates were going to stay even or higher,
right?
If I'm in a Roth, and I know I'm going to be leaning on Social Security as an income issue.
Right.
To me, I'd like to see the modeling, you know, kind of comparison of looking at that Roth with its extra value to my Social Security benefit. So if I'm in my 50s now, this is a good time to start making this call, because it's not, again, we can't do a crystal ball issue, but on the singular issue of Social Security alone, that might be worth doing it.
Well, sure, and you may find that's a really good point, is if you have a Roth IRA instead of a regular, and you get to the point to make a decision, do I take my Social Security income now or defer it and have higher payments later, having the Roth available to live on tax-free may give you the freedom to make that choice to defer taking your Social Security income at a later date. And that's just one of many combinations and situations to think about as you make these choices.
Now, of course, I've seen a lot of people whose employer offers something a little bit bigger than just a regular IRA. They're kind of a 401k. And I really like it when the employer goes ahead and does some kind of matching. I mean, we should be doing that, right? I mean,
oh, yeah, that's a no-brainer kind of thing. There's a lot of things that are difficult to compute or figure out the result. But, gosh, if you're putting away, $5,000 a year and your employer's putting $2,500 match or $5,000 match if you're really that fortunate, by gosh, of course you take that, because then you don't care so much about the tax impact, but you're getting additional dollars out of your employer.
Now, Ken, I've seen some advisors, and I'm kind of curious about your thinking on this. I've seen some advisors in their 401k and their IRA, they're putting annuities in.
Well, yeah. And
is that okay? I mean, is that, it sounds like it's, okay, I'm going to get email on this, I promise.
Oh, sure.
And they're going to blog me into the ground.
Yep.
But I keep hearing that this is from CPA Society. People you and I have taught it for say. A lot of people think this is financial heresy.
Oh yeah. Tax advisors, generally the first reaction is no way under any circumstances do you ever put a tax-deferred product into a tax-deferred account like an IRA. And if you're focused just on taxes, they're absolutely right. But there's other economic considerations. For instance, back in the early 90s when the Resolution Trust Corporation was dealing with real estate problems, the banks didn't want your money. They were dropping interest rates as low as possible, and people were taking the deposits out. I could go to an insurance company and get a deferred annuity, which is very similar. It's not guaranteed by the FDIC, but it's similar in how it functions in that it's a tax-deferred account, but I might get 2% higher. What we call 200 basis points is equivalent of 2%. So I don't remember the exact numbers, but I think it was like 6% on the annuity and 3% on a CD. Well, who cares about the tax aspect? Right. It's pure economics. If I can get a 6% and the CD at the bank's only paying 3%, who cares about the tax issue? Right. And today, Steve, we have these indexed annuities. And the indexed annuities have a potential upside that's substantial, and it's based on some market indexes. What's different, don't get crazy, it's not a loss situation. It's not like a mutual fund. It's very different. You have some of the potential of the market upside used to compute the interest that you're earning. You're not actually investing in the market. On the downside, if the market goes down and it's matching the index, you take no loss in those years on these annuities. So they're safer, but don't have nearly the upside, but they're somewhere in between. And those could make sense, especially with some of the other guarantees that associate them.
So if you set aside the tax deferral commonality that qualified plans and annuities have and say, what is the value of the contract in and of itself?
Right, the economic value.
And if that economic value works for me, I'm not going to have a problem putting that in a qualified plan.
That's exactly right. And then there's some special riders that are frequently available on the index annuities that will guarantee it's kind of complicated. You come up with a number, a formula value that is guaranteed to grow at certain rates over time, and then there's a guaranteed distribution at retirement. Well, the beauty of that is that once you start taking those distributions, that income's guaranteed for life, and you still have access to the cash values. And so it could make sense, and again, I'm being somewhat vague because it's just way too complicated to try and explain on the air. But your advisors, your financial advisors, your investment advisor, your insurance agent, your CPA, your bankers, there's a lot of people out there helping. They know about these kinds of products, and they've studied them, and they can guide you whether it makes sense for you or not.
I'm wondering if I wasn't, or if my employer wasn't matching, is there a kind of a tipping point where I would say, yes, I'm still doing it in the 401k because my bracket's high and I might as well get the deduction in my hand. It's worth something right away. But I'm wondering if there's some diminishing returner as I go lower in my bracket and I'm not going to get a match from my employer. Maybe I should say, not do it, right?
Yeah.
And go with this Roth idea.
Well, that's an interesting point, is if you get so much in deductions, you may get your tax rate down low enough that the benefits aren't really that attractive. Maybe what's more important is I see a lot of people that have accumulated wealth in qualified plans, retirement plans, a lot of businesses have their money tied up in their business, their qualified plans, their homes. On paper, they're worth a lot of money, but if you look at their bank accounts, there's very little cash in there because they're trying to be efficient, productive citizens and use the tax laws to their advantage. Maybe taking some money out and using some of these alternative assets where you have cash liquidity available, so that when you do get to retirement, you're not sitting there, oh my gosh, I'm 55, I want to retire, I've done really well, but now I got to pay full taxation on the IRA, 10% penalty. This is not a good idea. Whereas if you had layered your investments with various types of financial products, now you have some choices. We don't know what the tax law is going to look like 10, 20 years out, but if I have different types of vehicles, IRAs and mutual funds and exchange-traded funds and annuities and life insurance products and stuff, I can then look at the current tax law 20 years from now and say, where do I pull my money?
So what I hear you saying is sometimes the strategy could be a little of everything depending upon what advantages. So I might want to be able to just, hey, I'm not going to take the deduction because I want access to that money coming out free. I don't want it to encumber my Social Security benefit, letting it get taxed.
Right.
Or no, my brackets is so high, I might want to put some of it in there to get some deduction. And by the way, the old days, Ken, remember this, in the old days when we first started out, people would put their money in a 401k contribution and then take the tax savings and invest that. When have you seen that? I mean, that kind of died.
Well, and that brings up another point where the index annuities, people have invested in mutual funds and lost tons of money. 2008 was a very scary period of time for people. In early 2009, and a lot of them woken up and say, you know what, maybe a 2, 3, 4, 5, 6% return is worth doing if I can do it safely instead of taking huge amounts of risk. And that's another reason why annuities and qualified plans could make sense as well, where they're looking for safety and they want to move away from risk.
If I can lower my bill, and I thought it was going to be even money on the way out, you know, maybe I want to get my bill. Maybe I just need the cash flow now and go ahead and get the deduction. Like you said, we just don't know what's going to happen in the future. We have to try to plan today. And I think when you look at all the possibilities, whether it's 401k, Roth, IRA, you need your due diligence, sit down with an advisor, and really hammer out what math makes sense. Well, listen, I want to thank you, Ken, for being on our show today. Our sponsor, Brokers Alliance, and America, where anyone can go on a quest for financial freedom.